All right, guys, good morning. Good morning. Welcome aboard to the morning note. It is Friday. Happy Friday, everybody. February 10th, 2023, here on the YouTube channel. Time to rock and roll. Thanks for taking the time out of your day to join me this morning and every morning at 9 a.m. Eastern Standard Time. Let's get to work. All right, Dow futures are down 97 points. NASDAQ futures down about 0.75. We're off the lows this morning, from early this morning. I think we were down on the Dow as much as like 180 points. I was looking at around 5 this morning. S&P 500 futures 4073 down about 0.45%. Russell down about 0.40%. Crude oil is up on talks that Russia will be cutting down in terms of production. So that created a little bit of a pop on crude oil, up 1.33% at 79.09 a barrel. Gasoline futures up 1.38% at $2.48 a gallon. 3.684 on the 10-year Treasury yield, not up too much today. Dollar is pulling back from its overnight highs of around 103.52 or so. We are now up on the dollar around 103.34, up about 0.12%. Volatility index 2155. We're finally above that 20 level. We're now up 4%. We'll go ahead and chart that together as well. Gold futures are red this morning, slightly, 1877 an ounce. Silver futures 22.15. That's green this morning slightly. Dollar yen, we're going to go ahead and talk about that. I tweeted about that this morning. 130.76 on the new BOJ, head of the new BOJ. They're voting on this new person to be in it. So the yen is strengthening here. 130.76 down 75 pips. 106.97 for the euro dollar. That's down another 41 pips with the dollar being elevated. Remember, we were just around that 100 level at the lows. 101.97 was our support. We bounced off that. Let's see if we can finally get back down a little bit. Pound dollar is flat, 121.18. Bitcoin futures, 21,800. We talked about that death cross on the weekly. So again, expecting bearish momentum to the downside on Bitcoin. We talked about that yesterday. It is down. I expect that 20,000 level to hold as support, at least a psychological support. What's interesting about Bitcoin is the round number theory tends to work in terms of the crowd that looks at Bitcoin. Ethereum 1538 down 2.60% on Ethereum this morning on the futures contract. Okay, so we did have a couple of things that happened yesterday. Let's go over S&P 500 futures, and I want to go over something here on the Discord channel for all. I sent this to the Twitter as well, and also our market blog. And let me go and expand this a little bit. And what I said there was that what we are watching, I am still watching the 20 MA, which is right here. You see it right there, 40.65. So again, the 20 moving average, we know that's a momentum indicator. Up or down, you break below it or settle below it, more likely you're going to get more downside momentum. And if you stay above it or break above it, that's when you get some upside momentum. And the reason we say the 20-day moving average is because when we trade, we usually use the hourly chart, and that's based on a 20-day basis. So if you're above that moving average or that average of that period and you're elevated, again, that's still short-term momentum. So again, my opinion, 4,200 levels seem to be that key resistance. Remember, that was that 20% upward move from the October lows. Here's the chart that I posted on Twitter as well. We expect that if we have a hotter than expected CPI number, we just had our CPI number for December revised higher, about 0.2%. That was revised due to seasonal aspects. So again, starting to see a little bit elevated inflation here, at least from the reading side. So we have probably the most important CPI number. It's always important, right? On Tuesday, Valentine's Day, the 14th. So again, a hotter than expected CPI number could get us to that previous trend line right here. You can see it to your right. Again, this is SPX, this is SPX spot. So again, it's still the same chart with S&P 500 futures, but again, you're keeping an eye on futures here. 39.84 would be that trend line, or I believe 4,000 on SPX, right around that. So again, now support in terms if we break that is your 200 MA, and we know the drill. Nothing good happens below the 200 MA. We want to keep above that. We still have that golden cross going on. So we have that 50 above that 200. That's still intact. But again, tightening just a little bit. We want to get a little wider out on the 50 and the 200. One going higher, one staying where it is or going lower. But with that being said, 39.53 would be that support. That's your 200 MA support. This would coincide with that S&P 500 pre-election year seasonality mid-February dip. We talked about this. We posted this, guys, right here. A dip is expected. Maybe this is it. Maybe this isn't quite the full dip yet. But again, based on seasonality, if we have this kind of analog, January looks pretty similar. We had a nice spike into January, nice rise into February, mid-month kind of. You could see right towards the 14th, maybe. Again, it's not going to be exactly to scale, but again, a dip was expected, if not sooner rather than later. And then we are expecting a continuation higher, and then we'll dip towards the end of February, and then March, being one of the strongest months in terms of seasonality as well, would have a little higher and higher. Again, if this kept up this seasonality, let's just keep that in mind. But so far, it seems that we're finally we're kind of coming along to that script. And also, this is important here. Beware the latter half of February, one of the weakest times of the year. So we stretched out our time frame here, not just pre-election year, because 2023 is a pre-election year. Election year is in 2024. So if we stretch that out, 1950 to 2022, just the month of February, you can see that right towards the 15th, that's when we start getting a little less. It's a little weaker. So again, it does fit the script, yet the seasonality says we would bounce. But yet, if we stretch out every single February towards the tail end of February, we get weaker. So again, we have our roadmap. We know what we're looking for. We're looking to see if we hold that 20 MA first. If we settle below the 20 MA, which would be the end of day today, again, we always have, sometimes you have that power hour where you get that boost and then everything's all good. But again, we want to see a settlement below the 20. Now, again, if we start slicing to 40, 50, 40, 40, which would get us about 30 handles or 25 handles below that 20 MA, then we're starting to look at getting some downside protection as well, because now we know the momentum's to the downside. So again, we will probably take a look at the 400 puts on SPY, maybe take a look at QQQ, start preparing yourself. The only issue I have today is that this may be a little bit of a front running ahead of the CPI number. Granted, we have moved very high rather quickly. We had Fed Chair Powell kind of boost the market a little bit, kind of chop us around, then we went higher. We came back to back-to-back days, or 3 days in a row of being red. Well, 2 closing days of being red. So again, are we kind of front running a little bit of fear ahead of the CPI number? Obviously, this upward revision is not helping anybody, but yet the stock market is sort of bouncing, kind of ignoring that. So again, you're going to keep an eye on the yields. You're going to keep an eye on the dollar for any future price action hints in terms of equities here. We know if the dollar goes higher, we expect a little more weakness into stocks. So again, we know what our target is. We want to go ahead and as a bull, this is kind of in a weird way what you want. And why do I say that? Again, we want structured support like we talked about. We don't want just one straight shot up like the meme stocks in 2021, because that's not sustainable, as you know. So what we would want, what would be great, would be a retest, a test of this trend line, and use that as support and bounce us higher. That would be a really great win for the bulls, because that would show that, hey, that support is being held. There's buyers defending that level. The last time we had buyers defend a key level that important in the S&P was really the 200 MA back on the weekly, and that was right around 35.01. Yes, we sliced under it, but we settled above it twice. So again, we'll see if we start getting around that zone here on the S&P. Futures right around 39.95. And again, keep in mind, the longer the time frame, the longer we're above that trend line, the trend line number is going to get less and less, lower and lower, because it's a descending trend line. Here's the interesting part. The ascending trend line that we've had really since that 200 MA or the October lows, let's go and zoom out, and you could see kind of that setup here. Again, that's about to cross over. So again, could that ascending trend line be support? Well, that'll get you to right around 40.20, 40.30. I think that's less likely. I think more likely we'll be retesting the downward trend. I don't know. I would predict that would be more of a bear trap than anything else. And the only issue I have today is that with that front running of the CPI number, now downside protection costs are elevated, meaning insurance is going to be a little more expensive. If you're buying VIX calls, VXX calls, puts, or anything that's going to hedge your positions, they're going to cost more today because the market's down. So what we would want, if we wanted to buy some downside protection, let's say if we break above 4,100. If we can get above 4,100, I think buying some insurance would be prudent, especially if we get some momentum higher, maybe bouncing above that 20-day MA. Now, you'd be saying to yourself, well, Carlos, if we hold that 20 MA, why would I want to buy insurance? Again, you want to buy insurance when you can, not when you have to. And the last time I bought insurance on the portfolio in terms of trading was the QQQ puts for FOMC. We expected that 25 basis hike, yet the stock market went higher. Our puts didn't go anywhere. To be fair, we had those puts that actually hit the target, but it hit pre-market on Qs. But still, it was insurance. It did not pay off. You don't buy a Ferrari and have insurance on the Ferrari, hoping you'd crash it and pay out in your insurance. That's not what you would want to do anyways. So again, the downside risk is obviously there. But again, that 20-day, you need to settle below it. So today, I'm not really going to be looking at much in terms of action. We've already had a great week. Nice job on Tesla for the team. Yesterday, we caught that. Went a little higher, obviously. I think it went as high as, where did we go on Tesla yesterday? Tesla, we got as high as 150% on those 210 calls, and they were in the money. They were no longer in the money, but still, well done, team. 5 for 1 this week. Obviously, IWM calls did not work, but that's what happens when you kind of deviate a little bit. I wanted to get away from tech post FOMC. I kind of wanted to see if we get a little bit of rotation back into value. We didn't, but we did play value this week with Bank of America. Dollar index, again, we're looking at the chart here on the daily. Let me go and expand this chart for you guys. And again, we're still kind of hitting our head around that 50 MA right here on the daily. So again, maybe if we get to around 104, we'll see some more downside action. Maybe that coincides with that 20 MA with S&P. That sounds about right. Like the 20-day MA for S&P futures is kind of that support, while the 50 MA for the dollar index. And again, the dollar index is comparison of the basket of other currencies, mind you. So again, this is our best view of how to value the dollar in terms, right? We need to have to compare it with something. So again, that 50 MA is acting as resistance here. We still have a downward trend on the dollar. We still have that death cross while the S&P has a golden cross. So again, my opinion, for the time being, I think every dip is an opportunity to buy calls. That's how we've been trading it, and it's been working. But again, once you start getting to the really important moving averages, especially the 20 in terms of short-term momentum, that's where the facts change, and that's where you got to be a little more fluid. So again, we're leaning towards the downside, but if this 20 MA holds, this may not be a bad plan to see if you can catch some calls, especially ahead of the print. So again, maybe on Monday, if we close green today, let's say for example we do, and then Monday we continue a little bit of that momentum towards the CPI print, the CPI print may more than likely be a negative response, and then we continue down with the analog of 1950 to 2022, where the second half of February is weak. Or what we could do is continue to go down, test that trend line, CPI come into whatever number, let's say meets expectations, the market cheers it and then bounces. So again, the news is important, mind you, but it's the flow of orders and equities. We want to see if people are buying, we want to buy because we want to sell at a higher price. If they're selling, we want to sell because we want to sell at a lower price. All we're trying to do here as day traders and traders, guys, is really catch the wave. We use charts to at least illustrate to us where the flow of money is going, whether it's to the short side or to the long side. And that's really all we're doing every single day, which is always fun. Let's go and take a look at this correlation here, dollar yen versus the 10-year treasury yield. And I talked about this on Twitter. If you notice, the yen and the 10-year yield has been very closely correlated for the past year. Rolling 52 weeks, let's just say. Pretty tight, had some deviations, a little bit of a spread there, decoupling, excuse me. And then you could see that we did hit the peak in dollar yen right around the same time we hit the peak on terms of 10-year treasury yields. And then kind of started moving. We saw that yen fall really rather quickly, or the dollar yen fall rather quickly from around 147.50 to around 140. Same deal with the 10-year yield, it fell as well. So again, the correlation has been tightening, but now it has decoupled a bit. Now you're seeing that yields are kind of holding up while the yen is still continuing down. If we're expecting this correlation to still be the same like we've had the past year, then we expect rates to continue to go down as well. Maybe CPI isn't as bad as people foresee. Maybe the Fed isn't as hawkish as people are making it out to believe, because the bond market is pretty much the arbiter of that kind of view. And again, it's not just been the past year. You could see the tight correlation that we've had in terms of the yields and the yen. And the last time we've had a major decoupling of these two assets would be actually April of 2021, where yields got ahead of the yen, but then the yields actually came back down and met with the yen. So if we go by that kind of analog, more than likely we're going to see the 10-year treasury yields start testing around 3, percent, around 2.75% if yen levels clear. So again, there's always two sides to this. This could mean that the dollar is going to get stronger and yields are leading up. So again, we could be going into yen weakness where the dollar yen is meeting up with yields, or we're waiting for yields recouple to the downside with the yen. So if you're expecting or wanting lower yields and you want to keep track of it, watch the dollar yen. If the dollar yen is falling, that's when interest rates are going to continue to fall or expected to fall. Back in the day when I used to trade Forex, when interest rates were going down, it was usually a sign of recessionary or weakness or lack of growth, right? You need lower rates to spur growth. And the yen was the safety foreign currency, where if things went bad, which was a North Korean nuclear missile test, the yen always gained, meaning dollar yen slipped, it fell, and gold would go higher. So interesting, we're seeing that gold is higher, dollar yen is falling, yields are falling. Again, these are recessionary, playing it safe, risk off type behavior. But in an interesting way, the lower dollar is helping equities, and we know that lower rates help tech stocks. One more correlation before we answer some questions this morning. Let's take a look at Dr. Copper, excuse me. That's /HG for the futures traders. And here is the S&P 500 futures. And if we talk about correlation, this one is not as tight as the dollar yen and the 10-year yield, but Dr. Copper, meaning the purple line, copper futures, and the S&P have been pretty tightly correlated. Now, what I've noticed is that Dr. Copper has led the way, has been more of a higher beta, meaning it's been leading a little more than the S&P 500 did in the summer, where we had just the collapse in terms of commodities, where we peaked in the summer due to the strong dollar. And then the S&P did that bear market rally back in August. Copper bounced as well. Then we got tight correlation starting in the fourth quarter of 2022. Ascending triangle, same old deal. Breakout, same old deal. And you could see that we topped out right around $4.30 on copper, kind of similar to that, $3.10, right around 43.11 on $4.30 for copper. So that kind of links to 4,300 S&P. Wow, that's really interesting. You could just take away a decimal, and that almost kind of gets you into that area. Fun. So again, you can see the copper level has broken that trend line the S&P has shown. So has the S&P. So, but the copper is still lagging a little higher than it would be on the S&P. So we've known that copper kind of leads the leg lower, but when stock's a little higher, you could see back in August, copper didn't really do much, but it got close. So again, we're going to see either the S&P catch up back to copper, or copper is going to catch up back to the S&P lower. So far, the S&P is holding that 20 MA. We'll see what copper does moving forward. Copper this morning is down 1.29%. So there you go. Do we have the exact correlation? Let's see if it's been done for the past 3 years. Yeah, pretty tight correlation between Dr. Copper and the S&P. So if the copper market is falling, expect the S&P to go down as well. So a lot of macro hints out there for traders, that just don't want to see one single chart at a time. It's important to know how these things link together moving forward. So again, you have these hints. Macro, environment, prices are giving you hints on how maybe the stock market is looking appealing to either bears or bulls. Good morning, Zoomball Own. Appreciate you joining me this morning. If you like these videos, make sure to hit that like button, hit that subscribe button. What do we do today? Now let's talk about the rest of the day. I do have some Tesla calls for next week. It is down this morning, down to 203.08. I'm going to be swinging this and see if we hold above 200, if that's the case. But I had a Tesla trade yesterday, so we'll see what happens. I have it for the expiry of next week. We will see what happens in terms of CPI. That's really the big overhang. We have CPI on Tuesday, we have retail sales on Wednesday, and then we also have PPI on Thursday. So right now, that 20-day moving average on the S&P is the key. I don't have any other risk on the board in terms of short-term trades other than that Tesla trade that we did with Masterclass. I did not close it. I don't know if our Masterclass students did. It got as high as 113%. I just decided to hold Tesla to see if I can get to that 200 MA for next week. So I don't know if my guys got it, but I'm still holding it. So let me go ahead and move this comparison so we can take a look at Tesla. All right. And we'll go to the daily. And I want to go over a couple of more charts here. Okay, you could see that was the 200 MA, which is 225.45. We still have upward momentum on the daily, even though we're pulling back a little bit. More than likely, we will be filling this gap here of around 202.97. Now, that could be an opportunity for a bounce play, sure. But again, I will keep an eye on it as we go. If it breaks 200, then yeah, I may have to close this thing. But I don't think we get there. I think we're just filling that daily gap that we had from yesterday. Um, I also have a video that I recorded for Instagram talking about gaps. I'm just getting it all pretty for you guys, and I'll make sure to post it for you guys, explaining how gaps work and why we watch it, and if they have to fill or not. So that's Tesla. Again, I'm holding some calls. That's not a signal for members. That was a masterclass signal. I don't know if they're still holding it. It did get as high as 113% yesterday. Let's take a look at Meta. Meta has a huge downside gap, and you could see it here right around to 155.40, which would be your 20 MA. The stock is down about $1.80 this morning. If you're trying to play that swing and you're trying to find a way to trade this to the downside, really the best bet would probably to get to 170. I think that would probably get us a little bit more momentum. I don't think I want to wait for just a 175 break because that could bounce as well. That's still too close to that 20 MA on the S&P. Remember, Meta's part of the S&P as well. So again, they do move together, not all the time. Obviously, we know that Meta's a little higher beta. But again, I want to see how the market is responding. If Meta's up, usually the S&P is up. We know for the most part, and definitely if Nasdaq's up. So again, if we break 170, 170 level, I'll start taking a look at Meta to short and see if we can get back to the levels, maybe retrace that full earnings move higher, and then see if that gap does fill. That gets you to right around 155 to right around 153.26. So let's see if we break 170. We'd probably swing that thing, but it's a lot of space to get there. It may not happen overnight either, so take some time on Meta. Let's go ahead and take a look at QQQ. And as we know, we talked about this. We had this resistance here. We popped right above it. We are still not at that trend line. We're now slightly below 300 at 299.45. We're still above all major moving averages, which is a really, really great sign. Again, the 20-day being around 292.74. Support would be the previous resistance or your double top that we had, 296.87. If we get into that 296.87 zone and the macro is lining up in terms of the dollar, CPI, all this stuff, I think that's actually a buying opportunity. Even though we filled this gap already here, that's done at 307.96. So QQQ obviously did have a supremely excellent high, strong move to the upside. But again, we'll see what the downside risks are in terms of CPI and the dollar and everything like that. So I'm not expecting to do much today. I expect some sideways action for the most part. And we'll go over some scenarios on the newsletter on this weekend. So we'll send that out to you. Have a great rest of your morning. I think I dragged on too long. Have a great rest of your weekend and enjoy the Super Bowl. I'm going to go ahead and just say to the top of my head, I think the Eagles are going to win the Super Bowl. Whatever. I'm not going to bet on the game. I don't like both teams, but I think the Eagles win it. That's just the way it goes. Have a great rest of your morning. We'll see you guys on Monday. Cheers.